Hi, my name is CARLUCCI with Gustan Cho Associates, and you're wondering how lenders determine interest rates for loans. They ask for FHA, but let's just talk about all rates. So we look at a rate sheet. Your purchase price, your loan amount, your credit score, your debt to income ratio, your county that you're buying in, the state, the property you're buying as a condo or single family, etc., PUD, townhome, and is it primary, secondary home, or investment property. So those are basically all the check marks, and then you click conventional, FHA, VA, USDA, etc. And then bam, we get these rate sheets that pop up in this different banks that we have. So investors or banks, we bank our own loans, but we actually sell to investors. So each one of our investors has a different rate sheet, and one's going to be better than the other. Always, there's always one better than the other. It's not always that one's better. Sometimes they flip-flop, they take turns being better. So it depends how busy they are. They're going to raise the rates a little bit better or a little bit more to stop the business flow, and then the other bank will have better rates. They'll bombard that bank, and then it just keeps going back and forth. So rates are determined based by all those inputs, and we look at the rate, and there's going to be rates all up and down this board. You get 2.25 or you get 5%, and we're looking for the rate that's 0,000, which is really hard to find. It's not always that. There's always going to be a small credit or a small cost. So if you go to the 2.25 rate, you're going to see it's going to cost 3 points for that low rate. 3 points times the loan amount. So a $200,000 loan amount is going to cost $6 grand. Let's say you go to the 5% rate, you're going to see a 3% credit. So there's a $6,000 credit if you take that 5 1/8. So you're going to get closing cost credits if you take that 5 1/8. But somewhere in the middle, that 3.5 range maybe, you'll see 0.018, and there'll be a minus sign. That means there's a credit of 0.018 times your loan amount. So 200,000, you're talking like $30 that you're going to get a closing cost credit. Then the next rate that's lower might cost you 500, and the next rate, from that 0.018 credit one, the higher might be a 0.3 credit, and that'll be like a $600 credit. So you're always going to get a credit or a cost. We don't get to just charge you rates and make things up. We are fixed. We get the same amount no matter what. As long as we give you that par 00 rate, we get the same. Now, if we give you a lower rate, you got to pay for it. If we give you a higher rate, you get a closing cost credit. We don't get to keep that extra money. Back in the old days, prior to 2008, we would sell you 5 1/8. We would get to make that extra $6 grand on the loan. If we could sell that rate to you, we would get to do that. People were doing that, and that's one of the best regulations that came out of all this Dodd-Frank thing. The rest of it, I don't care for, but that was one of the good ones that was good for customers. That the mortgage broker can't just rip people off. We are not ripping anybody off. We're bad people to the government, so they're watching us. We can't do it no matter what. It's just regulated. Even if we charge you a higher rate, it automatically goes to you, that credit. So that's how we determine rates. It's complicated. You got any questions, you give me a call at 630-915-7550. Please subscribe.